Welcome to Griffonomics.
Glad to be here.
Imagine logging into your portfolio and you see that a company you own just formally erased like $1.4 billion from its books.
Yeah, that's a terrifying screen to wake up to.
Right. It posts this severe net loss, and yet you look at management and they're out there smiling. They're basically calling themselves a structural monopolist.
The massive contradiction.
Exactly. So today, we are deep diving into that exact contradiction at the heart of AeroVironment, ticker AVAV. And this is right in the wake of their $1.3 billion acquisition of BlueHalo.
Which is a massive integration to digest.
It is. So to figure out what's really going on under the hood for you, we've pulled together forensic financial analyses, the Q3 2026 earnings transcripts, and some really revealing strategic presentations from the JP Morgan, Citizens, and Bank of America conferences.
Yeah, the divergence between the headline numbers you just mentioned and the actual underlying operational engine here is just striking.
So our mission today is to generate a really granular strategic report for you. We're evaluating AeroVironment's post-merger integration, the actual architecture of their backlog, their physical manufacturing moats, and, how they're defending against this new wave of venture-backed startups.
It's a lot to unpack, but we really have to start with that headline shot.
Let's do it because it is incredibly jarring. So for Q3 2026, they posted a GAAP net loss of $3.15 per share.
Ouch.
Yeah, that's a $156.6 million hole. And alongside that, they casually announced the sudden forfeiture of options for the SCAR program.
Right, the Satellite Communications Augmentation Resource.
Exactly. This was supposed to be a cornerstone Space Force contract for their Badger ground stations. And just poof, $1.4 billion gone.
Just vaporized from the unfunded backlog.
Okay, let's unpack this, because if I'm looking at a business that just lost over $1 billion in future space contract options, and they post a painful net loss, I mean, it looks like an absolute disaster.
On paper, sure.
How on earth are financial analysts calling this a quality of earnings upgrade?
Because the GAAP income statement you're looking at is reflecting what forensic analysts are actually dubbing the BlueHalo Mirage.
The BlueHalo Mirage. Okay, explain that.
Well, when a company executes a $1.3 billion acquisition, like this BlueHalo merger, the accounting rules basically force them to record really heavy non-cash acquisition expenses.
Oh, like purchase price adjustments and that sort of thing.
Exactly. Purchase price adjustments and, substantial intangible asset amortization. So that $156.6 million loss, it's an accounting artifact. It's paper friction.
So Wall Street is just essentially ignoring a GAAP nightmare because it's phantom accounting. It's not like cash actually walking out the door.
The institutional investors certainly are ignoring it, because if you strip away that merger noise and look at the core business, it is actually scaling at a pretty unprecedented rate.
Wow, okay.
Yeah, they posted 38% organic revenue growth. They hit $408 million just for the quarter.
Yeah, that's huge.
It is. And their adjusted EBITDA guidance remains incredibly robust, sitting somewhere between $265 million and $285 million.
Okay, but math is math. You can't just amortize away a lost space contract. What about that $1.4 billion SCAR purge?
Right. So the SCAR situation really requires looking at the messy mechanics of defense procurement.
Walk us through it.
Back in January 2026, the U.S. Space Force issued a stop work order on that program. The reality was that the Space Force realized they simply lack the funding for AeroVironment's initial, highly exquisite Badger ground stations.
Exquisite meaning wildly expensive.
Basically, yes. The military couldn't afford those mission sets at that bespoke price point, so the Pentagon is pivoting toward open commercial tech and reopening the program to competitive bidding.
And knowing that the military was changing its mind, management just took a red pen to their own unfunded backlog.
They did. And honestly, it was a really shrewd move to regain investor trust.
How so?
Those $1.4 billion were unexercised, highly speculative options. They were never funded. So by completely flushing out that lumpy, unawarded pipeline, management effectively de-risked their forward guidance.
I see. So they're forcing the market to value the company purely on what they call their $1.1 billion funded backlog.
Exactly. The funded fortress.
The funded fortress. I love that. And our sources make a really vital distinction here for you listening. If you're holding the stock and trying to forecast FY27, this $1.1 billion is literally the only number that actually matters.
Because it's legally binding.
Right. It consists exclusively of government purchase orders where funds have already been explicitly appropriated and authorized by Congress.
Which is huge because it heavily insulates AeroVironment from the usual chaos of federal budget delays. or, continuing resolutions.
So they swapped a speculative $1.4 billion hope for a concrete $1.1 billion reality.
Yes, giving them ironclad forward visibility deep into fiscal year 2027.
Okay, fleshing out bad options is great for transparency, but AeroVironment still has a massive revenue gap to plug from that lost SCAR potential.
Right, you still have to replace the growth.
Exactly. And that brings us to the very real friction of the post-merger integration. The sources highlight a tangible dip in their space, cyber, and directed energy segment, the SCDT split.
Yeah, the Cyber and Mission Systems unit actually took a 22.5% year-over-year pro forma revenue dip.
Which is concerning. I mean, a 22.5% drop usually triggers panic that a legacy contractor is losing ground to newer, faster tech startups.
It usually does. However, CEO Wahid Nawabi explicitly categorized this across multiple conferences actually as a lumpy execution window.
Yeah.
He's insisting it's not a permanent loss of market share.
Caused by what, exactly? Just the headache of absorbing BlueHalo.
It's a combination of that internal corporate restructuring and broader Department of Defense budget transitions at the start of the fiscal year. AeroVironment maintains that their offensive and defensive cyber capabilities are highly specialized. They're uniquely required by the intelligence community, and they fully expect that unit to stabilize as the integration smooths out.
Well, to counter that friction, they are clearly leaning into alternative frameworks. Like, on May 12, 2026, the Department of War awarded AeroVironment a $43 million contract.
The PANTHER contract.
Right, to integrate their PANTHER phased array antenna onto Skyrange platforms for hypersonic missile telemetry, which is an incredible piece of technology.
Absolutely.
But I really have to push back here. $43 million is a drop in the bucket compared to a $1.4 billion SCAR option loss. I mean, it feels like a prestigious Band-Aid just to distract investors.
If we connect this to the bigger picture, the PANTHER contract isn't designed to replace SCAR dollar for dollar overnight.
Then what is it doing?
Its true value is that it serves as a live proof of concept for AeroVironment's entirely new margin strategy. They are fundamentally changing the economic model of how the BlueHalo segment sells technology to the government.
Ah, you're talking about the pivot to the commercial catalog model.
Exactly. Historically, units like BlueHalo operated like traditional defense contractors. The government would ask for a bespoke piece of technology, and the contractor would build it using a time and materials research and development contract.
And those are notoriously clunky, right?
Oh, incredibly clunky. Every single nut and bolt is audited, the margins are strictly capped by the government, and the development cycles can take a decade.
Right.
So AeroVironment is aggressively transitioning systems like the Badger ground stations and the LCZ-OST laser weapons away from that archaic framework.
So instead of a 10-year bespoke R&D program where their margins are constantly capped, they are just, handing the Pentagon a menu with fixed prices?
Pretty much. They are packaging these advanced systems into standard commercial items that can literally be sold from a published catalog. And this changes the fundamental economics of the business.
Here is where it gets really interesting for anyone analyzing their profitability. In a traditional time and materials contract, if AeroVironment figures out how to manufacture a drone 30% cheaper, the government audits the cost and keeps those savings.
Which penalizes efficiency, really.
Exactly. But under a commercial catalog model, the price is fixed. So if AeroVironment uses its own engineering to drop production costs by 30%, they get to keep every single penny of that as pure profit.
That is the structural monopoly insight right there. They completely bypass the endless cost justifications.
Wow.
This model drastically accelerates global adoption. And as they scale these product lines over the next 1 to 2 years, management expect their blended EBITDA margins to expand and return to their historical target of 18%.
But this introduces a glaring logical hurdle.
Okay, what's that?
If you are rapidly shifting from bespoke R&D projects to fixed catalog hardware, your factory floor has to be flawless. I mean, if you pivot from building Badger space stations to PANTHER hypersonic trackers and Lokius directed energy lasers, doesn't that require spending billions of dollars to entirely retool your assembly lines?
You would think so. But the CFO's presentation addressed that exact assumption with a truly surprising data point. Executing that new PANTHER contract requires zero major capital expenditures.
Wait, really? Zero capex? How is that physically possible when you are building a completely different weapon system?
It relies on a concept we are calling the Albuquerque Moat.
The Albuquerque Moat. I like the sound of that.
Yeah, so AeroVironment Space and Directed Energy Campus in New Mexico features automated RF anechoic chambers and an end-to-end directed energy integration facility.
Very fancy term.
Very fancy. But the real leverage comes from their engineering philosophy of hardware commonality.
I love this concept. It's closer to the modern automotive industry's shared chassis model.
Exactly like that.
Just like Volkswagen uses the exact same electric skateboard chassis to build a cheap hatchback or like a luxury SUV, AeroVironment uses the exact same core hardware components across its catalog.
Right.
So whether the military orders a Badger ground station to talk to satellites, a Panther system to track a hypersonic missile, or a low-CST laser weapon to shoot down a drone,
The underlying tech for acquiring a target, tracking it, and pointing at it is universal.
and crucially, it all runs on the exact same proprietary software layer called AVAV.
AeroVironment.
Yeah. So the financial takeaway here is profound. Because of that shared manufacturing DNA, AeroVironment doesn't need to pour capital into a new factory every time the Pentagon changes its mind.
They just pivot.
Seamlessly. They redirected the existing production lines, the ones originally waiting for the Pause SCAR program, straight into manufacturing Panther and Locust systems. They just changed the software personality of the hardware.
Having a universal zero capex manufacturing line is a brilliant defensive moat, but, it only matters if the military actually wants to buy the physical products rolling off of it. Right, you still need demand.
And that is where the precision strike and directed energy segments are putting maximum stress on their margins right now. The low CST directed energy weapon just hit some major near-term thresholds.
Like that critical laser demonstration at White Sands in May 2026.
Exactly. Talk about that.
The White Sands demonstration was a pivotal moment for their Golden Dome initiative.
The Golden Dome.
Yeah, they are pitching a multi-domain defensive architecture utilizing these LUST systems. Basically, these are scalable, non-kinetic lasers designed for the localized defense of critical infrastructure.
So you can mount them on a vehicle.
On a vehicle, or fix them to protect a forward operating base. And they completely integrate with existing radar and command systems.
It sounds like science fiction, but they have already completed low-rate production.
They have.
At the same time, we really have to look at the core cash engine of the company today, and that's a precision strike segment.
Oh, absolutely.
This unit is soaring, up 50.6% fiscal year-to-date to $515 million. They landed a $2 billion sole source IDIQ contract,
Which is massive.
meaning the military has essentially handed them a pre-approved exclusive credit card with a $2 billion limit, completely locking out competitors from bidding on those individual orders.
The U.S. Army is aggressively stockpiling these systems right now. AeroVironment is currently rolling out the Switchblade 600 Block 2 and the 300 Block 20.
And the Block 20 is particularly notable, right?
Very much so. It features warheads that the user can actually swap out in the field, which fundamentally changes battlefield logistics. You don't need to carry 3 different types of drones anymore. You carry 1 drone and 3 different payloads.
That's incredibly efficient. But there is a hidden cost to this massive scale-up. The shift toward high-volume hardware production is causing temporary downward pressure on their gross margins.
Yeah, hardware carries inherently different economics than software or services. Product revenues now make up 68% of AeroVironment's revenue mix versus just 32% for services.
And that squeezes them initially.
Exactly. When you spin up initial manufacturing lines for these upgraded physical platforms, you carry much higher specialized component costs.
Right.
It takes time before the fixed factory overhead costs are fully absorbed by the sheer volume of production.
Right.
The early units simply cost more to build until the assembly line hits maximum efficiency.
So if hardware is this capital intensive and drags down margins early on, why are Silicon Valley venture capitalists suddenly pouring billions into defense startups to compete in this space?
It's the multi-billion-dollar question.
Right. We are seeing microcaps like Red Cat and Ondas and venture-backed unicorns like Endural and Skydio generating unbelievable hype. If I'm a procurement officer at the Pentagon, why not buy a $3,000 commercial quadcopter from a slick new startup instead of a $20,000 AeroVironment Switchblade?
What's fascinating here is management's counter-argument to that Silicon Valley threat.
Yeah.
It's deeply rooted in the harsh realities of federal procurement.
Okay, how so?
They argue that venture-backed startups are largely living in the software prototype phase. Building one beautiful, highly functional prototype to secure venture funding is a vastly different discipline than operating at what the DoD calls program of record-level rigor.
Which basically means it has to actually survive the bureaucratic and physical realities of the military.
Exactly. Startups often rely on cheap commercial supply chains. Sometimes they're unknowingly incorporating components sourced from China.
Which is a huge red flag.
Right. Those systems cannot legally or securely enter U.S. military stockpiles. The military requires hardware that can sit in a wooden crate in a desert environment for 5 years, pass severe unexploded ordnance safety certifications, and then function flawlessly in a heavily jammed electronic warfare environment.
And getting from that slick prototype to a combat-ready stockpile involves surviving what the industry ominously calls the Valley of Death.
The Valley of Death is brutal.
But the federal procurement cycle is notoriously slow. A startup might get a Phase 1 or Phase 2 research grant to build their drone, but transitioning to a Phase 3 program of record takes years of congressional budgeting.
Yep.
The startups simply run out of venture cash and die waiting for the Pentagon to actually buy something.
Whereas AeroVironment already possesses the automated factories and the program of record status. Furthermore, they actively weaponize their internal R&D, their IRAD, to ensure these startups can never catch up.
Weaponize is a strong word, but it fits.
It really does. The forensic analysis shows AeroVironment is deliberately suppressing their near-term EBITDA margins to funnel 7 to 9% of their total revenue directly back into IRAD. They are entirely self-funding their innovation cycle.
And the result of that heavy IRAD spend is generational lapping. By the time a venture-backed startup navigates the Valley of Death, survives the congressional budget cycle, and fields its very first functional prototype.
AeroVironment is already mass-producing Gen 3 or Gen 4.
Exactly. They aren't waiting for the Pentagon to ask for a new weapon. They are building it ahead of the requirements using their own cash.
However, there is one heavyweight threat that management cannot just brush off as a garage-built startup starved of capital.
Right.
And that is SpaceX, specifically their Starshield division.
The elephant in the room.
Very much so. The Space Force's pivot to commercial, open tech for the SCAR program directly mirrors the SpaceX playbook of utilizing mass-produced, low Earth orbit satellite networks.
Right.
The lingering fear is whether vertically integrated launch providers can use their massive economic advantages to poach ground station and telemetry contracts.
I mean, if SpaceX controls the rockets and the satellites, what stops them from just building the tracking antennas, too? It's a terrifying vertical monopoly for legacy contractors.
It is arguably the single biggest existential threat to legacy space defense margins today.
So how does AeroVironment defend against that?
They defend against this commoditization through their own deep vertical integration. They don't just assemble off-the-shelf parts. They design 90% of their subsystems in-house.
Wow, 90%.
Yeah, that includes the physical structures, the avionics, the propulsion systems, and the tracking gimbals.
Which is huge for quality control.
Exactly. When you combine that proprietary hardware with their AVAV software architecture, it makes their systems incredibly difficult for the military to just rip and replace.
And this is exactly why their pivot to the commercial catalog model is so urgent, isn't it?
Yes. They have to remain the low-cost, frictionless alternative before a giant like SpaceX can fully corner the ground station market.
This intense competitive landscape brings us to the ultimate question, really, if you are trying to value this defense monolith in 2026. Because there is a severe macro overhang right now.
Multiple compression.
Exactly. Institutional capital is rotating out of mid-tier defense tech stocks. Everyone is hoarding their dry powder for the anticipated $1.5 trillion SpaceX summer IPO.
It's sucking all the oxygen out of the room.
It is. If big institutional funds want to buy into SpaceX, they have to sell something else to raise the cash. And that rotation is causing multiple compression for companies like AeroVironment, artificially suppressing their share price despite that 38% organic growth we talked about.
The broader market dynamics are undeniably weighing on the stock's valuation multiple. But management's strategy to fight this compression is to definitively prove their claim of being a structural monopolist.
Right.
To replace the revenue void left by the SCAR program and justify their premium valuation, they are aggressively avoiding single points of failure. They are actively cultivating a basket of distinct product lines that they expect to become standalone $1 billion franchises.
So they aren't betting the whole company on one space contract anymore.
Not at all.
They have the Freedom Eagle 1 kinetic interceptor. They have the P550 eVTOL, which is directly targeting a $1 billion Army Long Range Reconnaissance Program, and they're scaling the Red Dragon one-way attack systems.
The structural takeaway from all of these sources is clear. The JAP losses dominating the headlines are a distraction. It is paper friction from the BlueHalo integration.
The BlueHalo Mirage.
Exactly. The intrinsic value of the company lies in that $1.1 billion funded fortress, their unparalleled manufacturing scale in Albuquerque, and their unique ability to out-commercialize competitors. While smaller startups are diluting their stock just to survive the valley of death, AeroVironment is aggressively expanding its Tier 1 capabilities on its own dime.
Which leaves us with something I want you to mull over as we wrap up this deep dive. If the Department of Defense is fully embracing this commercial catalog model for everything from hypersonic tracking software to directed energy lasers, what happens when the military procurement process stops looking like a decade-long congressional debate and starts looking more like adding items to a digital shopping cart with next-day deployment?
It's a wild thought.
It is. Does this new model truly democratize defense by letting the best tech win instantly? Or does it just create a new class of untouchable mega monopolies who happen to own the catalogs?
Risk defined. Portfolio protected.